today, I picked it as Serko. I had a chat with one of our New Zealand guests earlier today. It's out upgrading its revenue guidance after what has been a pretty strong December, January trading period. It is a software as a service technology business, and it is leveraged to the online, well, to the travel thematic, right? It's an online booking system and expense management systems for the travel industry in particular. So it's now expecting revenue to come in between $42 and $47 million. So that's an increase of between 123 and 149% on total income. So Andrew Page, strawman.com, I thought I would start with you on this one because Serko is just one of many little tech companies that was absolutely savaged last year. But, you know, potentially the worst is over. What do you think?
Well, there'll be a lot of shareholders who hope that's the case. I mean, even the last 12 months, shares are off 60 something odd percent. Since 2021, shares are down 75%. I think we need to realistically cut them some slack. Obviously, there was a very obvious reason as to why that's happened. And it looks as though things are starting to improve. I mean, even if you want to sort of take out COVID, the update that they've given here is for something, even at the lower end of that range, is a 70% increase on pre-pandemic revenue. So that's really great. They had a pretty solid, if you want to sort of normalize sort of revenue growth since they listed, it was certainly on the right trajectory. The thing here, and I think this is a theme, Nadine, that you see right across the market, and particularly in the small cap space, is that we've talked about this before, we went from this dynamic where the market only cared about top line growth. And now the market, I think very rightly, cares also about sort of sustainability and unit economics and actual cash flows, because it is a very different environment to sort of tap shareholders on the shoulder and ask them to open up their purses and wallets. So they are still EBITDA negative here. But if they can resume some kind of return to trend on that top line growth, and if they can sort of manage to stand on their own feet, there is potential for a bit of a re-rate. I mean, you do also need to put things in context. Despite the narrative, valuation as always matters. And on some very quick numbers, it looks like they're still on about 5 times sales, which is up there. Hopefully they'd like to get a bit of operating leverage and whatnot out of the back of that. But look, this is a nice bounce today. There's a long way to go to catch up on some of those share price levels from a year or two ago. But I'll just be waiting to sort of see, as I said, that things can get closer to a break-even and more sustainable basis. And I think if that can happen, the market will likely see a pretty big re-rate.
So too soon. If you're in it, would you hold it?
I don't know it well enough, but I'm always a little bit nervous. Travel companies have some great characteristics, but as we have seen, they can be hyper cyclical. So the good thing about well, there's not much good about a company that you're sitting on a large capital loss, but one of the good things is you don't have any tax considerations, so you can always sell out, wait to see if things sort of improve, and then get back in. Yes, of course, you risk buying back in at a higher price, but you may be buying back in at a higher price, but with more certainty. And I think that counts for a lot. So I'd potentially be looking to maybe wait to sort of see some firmer signs before I was to buy back in.
Okay, so that's an avoid. All right, let's get your view, Mathan, because you know there are those that are questioning when you start to add some growth back into your portfolio with some of these companies that have been so beaten down.
Yeah, it's a $64 million question. Everyone's basically been trained to buy growth stocks by the dip. Because there's a bailout of some sort coming. We don't think that's coming. It is a growth value switch. I mean, this one was hit $8 in 2021, peak of the growth cycle.
Yeah, I remember.
Everyone's paying massive multiples. But the important thing to look at is where they were pre-pandemic. So pre-pandemic, they got to about $5. So where they are now, it's substantially lower than where they were pre-pandemic. So in context, even if you remove the bubble, it's come off. It's a New Zealand tech. I always like New Zealand techs. And it's very cyclical, obviously, with travel, what's happening. I think the big thing that everyone's going to be worried about is the recovery cycle is reliant on consumer spending. And everyone is expecting consumer spending globally to slow down in 2023. So that will have an effect. travel prices are extremely expensive. I mean, whether you look at hotels, airline tickets, all of that, I don't know how long they can hold it together. This is one, it interests me because where it's trading, but Andrew's right. The execution is going to be tough in 2023. So I'm not jumping in, but it's one I'm keeping an eye on because it is one when we hit the bottom and when we start to look at economic recovery, these are cyclical stocks that have been belted. So the upside is there for you to play it. So I like it for that play, but unfortunately I expect over the next 3 months you're going to get a lot more negative economic news because the market's overly optimistic, whether it's China or Europe. So when that rebalances, I think this will potentially have a problem. So I think it's not going to do a lot over the next 3 to 4 months, but I will be keeping an eye on, and Andrew's right. Market is paying, used to pay for top line forecasted growth. Now they're paying for profit. You've got to have profit. You've got to have dividends. That's what they're chasing. And this is not going to be there in the short term. So you don't need to rush in. But I think this is one you keep on your list. When you start to see economic recovery, consumer spending holding up, then you jump into it. So I think you got time, but not right now.
There you